What is a stock? Stock is simply a piece of a company. Stock represents ownership and is an asset you can buy. The people who own the stocks are called shareholders. For example, if you and your family going to eat a pizza that has 8 slices, everyone will get a piece or slice. Out of the 8 slices, you get only one and your dad gets 2. You got 1/8 or 12.5% of the pizza and your dad gets 2/8 or 25%. Company works the same way. But instead of 8 share of stocks, they could have share of stocks in the million or billions. McDonald's has 797 million shares, Walmart has 2.9 billion shares outstanding and Facebook has 2.67 billion outstanding. Share outstanding is the term used to explain the total amount of company on the stock market for shareholders to buy and sell amongst themselves. Shareholders can be people or different types of institutions. Also, you are not limited by geography when investing, because you can buy from companies around the world. So if you want to buy stocks from the companies in the UK or India, you can. One thing you need to pay attention to is that there are 2 types of stocks in the market: growth stock and income stock. Companies that see their stock price rise up fast, like technology companies, are growth stocks. For example, Facebook and Twitter. These are rapidly growing companies and any income they make is put back in the company for further growth and expansion. Income stocks are stocks that periodically pays their stockholders a dividend quarterly, monthly or annually. The companies who can afford to pay their shareholders income are large, well-established companies, like Procter & Gamble or the Pepsi Company. There are benefits for owning both growth and income stocks. Growth stocks have the potential to increase in value fast, but they are also more volatile and risky. Income stocks, on the other hand, provide a consistent stream for dividend income, but stock itself might not appreciate in value as far as in growth stock. There are also 2 different types of investors: growth investors and value investors. Growth investors love it when they see stock price increase in value, also called a capital gain. Value investors like analyzing a company's matrix and numbers and are willing to wait until it is right time to buy shares in a company. Value investors are good at discovering great companies or consistent performers. They are likely to stay consistent in the future, based on the product or services they sell on the market they are in. What is the stock market? The stock market is like any other market where buyers and sellers come together to trading goods and services. The 2 most well-known stock exchanges in North America are the New York Stock Exchange and the Nasdaq. It's on these stock market you shares in companies like Snapchat, Apple, and Starbucks. One of the main difference between the New York Stock Exchange and the Nasdaq is that the New York Stock Exchange offers traditional trading, and the Nasdaq is totally electronic. Traditional trading is face-to-face trading where buyer and seller of stock are on the trading floor executing orders. On the Nasdaq, all orders happen electronically through computers and telephones. Many small and up-and-coming companies be traded over the counter or OTC. This is where investors can buy penny stocks. There have been many times in history where the market crashed and people ended up losing all or most of their money. Why does the market go up and down, and crush every couple of years? For an explanation we have to look at both short-term and long-term. Short-term market fluctuation could be triggered by anything like shareholders' speculation, bad news about a sector, changes in government and policies, companies meeting and exceeding their projected goals, and the list goes on. Fluctuations in stock market are influenced by the market cycle we are in. During times of prosperity, the stock market is in a bull market, meaning an upward trend. In times of economic hardship, the stock market tends to be a bear market, the downward trend. Stock market crash occurs when there is a dramatic and swift decline in stock prices across many sectors and industries. This decline happens quickly in just a few days, or it can take some to hit the bottom. This drop is so significant the stock market ends up closing early in order to prevent the stock prices from declining even further. A stock market correction should not be confused as a crash. A correction takes place when market has been overvalued and it need to be adjusted by coming down to a respective valuation. Market correction happen often and usually don't last very long, because when they have been readjusted, it's back to business as usual. A stock market crash can be influenced by many events like an economic depression or recession, instability in countries and stockholder speculations, betting up shares, so much that they form stock market bubbles. Making money with stock market. The two common ways investors make money in stock market are with capital gains and dividends. Capital gains. When you have your money invested in the stock market, the values of the asset goes up and down. When your money increases, also called as capital increases in value, you have just received a capital gain. And when it decreases in value, it's called a capital loss. As long as your money is invested in the stock market, it's unrealized. It only becomes realized once you sell your stocks. Example. You decide to buy 100 Nike shares at around $65 without any trading fees. You end up buying $6,500. This also what your Nike stock capital worths. A few days go by and you decide to check on stock's performance. You notice that the Nike stock capital drops from $65 to $61. So your capital also dropped in value from $6,500 to $6,100 to be exact. You lost $400, which is your capital lost. After few days it's $72. You have just experienced your first unrealized capital gain. Dividends. The second most common methods investors make money is what dividends they receive from dividends-paying stocks. Let's stick with the Nike stock example. You bought 100 shares at $65, but instead of selling for a capital gain, you decided to hold on to those stocks for 1 year. Nike has made 4 dividends payments of 18 cents per share for the year. With your 100 shares, you received $18 per single quarter or $72 total. The great thing about dividend is that these payments get deposited in your cash account, or you can also reinvest them to buy more whole or fractional shares. These whole or fractional shares end up paying you dividends. There are also disadvantages to dividends. The money you receive from dividends is mostly a lot lower that you would receive than capital gain. Dividends are also long-term strategies. They are not also get rich quick. Thank you for watching the video. Click subscribe and like button for more videos.